How to increase your credit score to 800 plus in 6 months. Achieving an 800 plus credit score in just 6 months might seem like an ambitious goal, but with the right strategy, it is absolutely attainable. Your credit score plays a crucial role in your financial life, affecting everything from loan approvals and interest rates to insurance premiums and even job prospects. A higher credit score can help you secure better terms on mortgages, car loans, credit cards, and other financial products, potentially saving you thousands of dollars in interest over the years. If you're aiming for that coveted 800 plus credit score, there are specific steps you can take to make a significant improvement in a relatively short period. In this guide, we'll walk through practical strategies, habits, and tips that can help you raise your credit score to 800 or more within 6 months. Understanding credit scores. Before diving into the steps to increase your credit score, it's important to understand how credit scores are calculated. Credit scores are typically based on 5 key factors. Payment history, 35%. This is the most significant factor in your credit score. It reflects whether you have made your payments on time, including credit cards, loans, and mortgages. Late payments, defaults, and bankruptcies will negatively impact your score. Credit utilization, 30%. This is the ratio of your current credit card balances to your total available credit. Lower utilization rates are better for your score. Ideally, you should keep your credit utilization below 30%. Length of credit history, 15%. A longer credit history typically boosts your score. This reflects the age of your credit accounts, including your oldest account and the average age of all accounts. Credit mix, 10%. Having a diverse mix of credit types, such as credit cards, retail accounts, mortgages, and installment loans, can improve your score. It shows you can responsibly handle various types of credit. New credit, 10%. Each time you apply for credit, a hard inquiry is made on your report, which can cause a temporary drop in your score. Opening too many new accounts in a short period can negatively impact your score. Step 1. Check your credit report for errors. The first step in improving your credit score is to obtain and review your credit report. You are entitled to a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once every 12 months at annualcreditreport.com. You should request a report from all 3 bureaus to ensure that the information is accurate across the board. Look for any errors or inaccuracies, such as incorrect late payments, accounts that don't belong to you, or outdated information. Disputing and correcting these errors can quickly give your score a boost. It's also important to check for signs of fraud or identity theft. If you find anything suspicious, take immediate action to report it and get it rectified. Step 2. Pay your bills on time. Every time, your payment history makes up the largest portion of your credit score, so ensuring that you make your payments on time is absolutely essential. Late payments, collections, and bankruptcies can have a significant negative impact on your score. To stay on top of your payments, set up reminders or automate bill payments wherever possible. If you're unable to pay off the full balance, make at least the minimum payment to avoid late fees and a negative impact on your credit score. If you have missed payments in the past, hit current on all your bills and continue making timely payments going forward. Over time, your positive payment history will help improve your credit score. Step 3. Reduce your credit card balances and lower your credit utilization. Credit utilization is the second most important factor in your credit score. It measures how much of your available credit you are using. High credit utilization can signal to lenders that you may be overextended and may have difficulty managing debt. Ideally, you should keep your credit utilization below 30%, but for a significant boost to your credit score, aiming for 10% or less is even better. If you currently carry balances that exceed this threshold, take steps to pay them down. Start by prioritizing high-interest credit cards to reduce the amount you owe and avoid accumulating more interest. One effective strategy is the debt snowball method, where you focus on paying off the smallest balance first while making minimum payments on other cards. Once the smallest balance is paid off, Apply that payment amount to the next smallest debt, and so on. Alternatively, you could use the debt avalanche method, where you prioritize paying off the debt with the highest interest rate first. If paying down your balances in 6 months seems daunting, consider asking your credit card issuers for higher credit limits. This increases your total available credit, thus lowering your credit utilization ratio, though it's important to avoid spending more in the process. Step 4. Avoid opening new credit accounts. Opening new credit accounts can negatively affect your credit score in 2 ways. First, through the hard inquiry or hard pull when a lender checks your credit, and second, by shortening the average age of your accounts. When you apply for a new credit card or loan, a hard inquiry is added to your credit report. While each hard inquiry only causes a small drop in your score, multiple inquiries in a short period can add up and cause more significant damage. Additionally, opening new accounts lowers the average age of your credit accounts, which is a factor in your credit score calculation. To avoid these negative impacts, refrain from opening any new credit accounts while you're working on improving your score. Focus instead on paying down existing balances and improving the other aspects of your credit report. Step 5. Negotiate and settle existing debts. If you have old or outstanding debts, particularly ones that are close to being charged off or are in collections, consider negotiating a settlement with the creditor or debt collector. You might be able to negotiate a lower amount owed or establish a payment plan. While settling a debt may not immediately boost your score, it can prevent further damage and may lead to the account being marked as paid or settled on your credit report. However, keep in mind that settling a debt can still negatively affect your credit score in the short term, as the account will be marked as settled, but over time, it's better than leaving the debt unresolved. If you've already settled any accounts, ensure that they are reported as settled or paid to prevent future issues. Step 6. Become an authorized user. Another way to increase your credit score is by becoming an authorized user on someone else's credit card account, especially if they have a good credit history. As an authorized user, you can benefit from their positive payment history and credit utilization without being responsible for making the payments. For example, if a family member or close friend has a credit card with a low balance and a long history of on-time payments, being added as an authorized user can help boost your credit score. However, make sure the primary cardholder has a solid history of responsible credit use, as any negative activity on the card could also affect your credit score. Step 7. Keep old accounts open. The length of your credit history makes up 15% of your credit score, so it's important to keep your old credit accounts open and active. Even if you don't use them regularly, keeping them open can increase the average age of your accounts and contribute to a higher score. If you're tempted to close unused credit cards, think twice. While it may seem like a good idea to cut down on the temptation to overspend, closing a credit card can lower your overall credit limit and increase your credit utilization ratio. Instead, consider using these accounts occasionally for small purchases and paying them off promptly to keep them active without accumulating debt. Step 8. Use credit building tools. There are also tools designed to help you build your credit quickly. Some of these include credit builder loans and secured credit cards. A credit builder loan is a small loan that you borrow and repay over a set period, with the payments reported to the credit bureaus. While the loan funds are typically held in a separate account until it's paid off, the positive payment history can help increase your credit score. Secured credit cards are another useful tool. These require a deposit, which serves as your credit limit. If you consistently use the card and make on-time payments, it can help you establish or rebuild your credit score. Over time, you may be able to transition to an unsecured card, and the positive history will contribute to a higher score. For added card safety, check out the links in the description to some highly rated RFID blocking wallets. You can purchase them directly to keep your credit cards secure. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.